Today is one of my favorite subjects. Today we're going to talk about going public and staying private, and about the regulations that pertain to companies that are going to sell securities, sell stock, either to the general public or to a limited selection of the public, either to accredited investors on the one hand, or in the case of crowdfunding, there are some new exemptions that will allow the sale of securities to the general public through certain websites called portals. Now, as a reminder, we are dealing with securities. And securities in this case typically refers to stock, usually preferred stock, sometimes common stock, usually common stock, sometimes preferred stock. But the definition of security is broad, and there's always someone who has a too clever by half idea about how to do an end run around the securities laws. So we're not spending a lot of time on it, but there is the Howey test, which we'll briefly, I'll share some information about that, a 4-part test that captures investment contracts into the definition of what is a security. But we're primarily talking about the sale of stock. Now, when a company goes public, they do so in what's called an initial public offering, an IPO. And these have actually become less recently there's been a sort of a resurgence in them, but for a couple reasons I'll try to explain, there was a real slowdown in the IPO market. In order to go public, you have to file a Form S-1, and so we're going to take a quick look at that form, talk about sort of some of the contents there. And in addition to those steps, that's only to register so that you can go on a stock exchange. There is an additional step of listing on a stock exchange, and the rules will be different depending on what stock exchange you're listing on. So that's what we'll cover first. So what is a security? The definition of security is found in, shock, the Securities Act. The Securities Act of 1933 defines a security in Section 2A1. And this includes your common instruments like stocks as well as bonds. Bonds will also be regulated. Now, bonds are a bit different than stocks. Is everyone here familiar with bonds? Bonds are a different kind of investment. Bonds are a debt investment. And the way a bond works is that you purchase a bond, so you will actually pay for effectively a certificate. It used to be a physical certificate. Remember, my grandpa had these, and he kept them in a lockbox under the bed. So it's very grandpa of him to do that. And so grandpa kept his bonds in a box under the bed, but he actually had to take them out once a month, because on the bond is something called a coupon. Kind of like the coupon you'll take when you want to, actually now it's all digital too, but there used to be these things called coupons that you would like clip and take to Giant Eagle and get like $1 off on bananas. Very much like that. On the bond, there's actually a coupon, and you used to clip it off and send it in each month. And they would send you a certain amount of money in return for that coupon. And at the end of it, you sent the remaining certificate in with no coupons remaining and received your principal back. Was that me? Sorry. It's okay. It sounded like my alarm. I think we all have the same iPhone. So effectively, this was just a tangible way of having a stream of payments over time. And the notable thing about a bond was it had this percentage of interest. So if you had a 10% bond, then if you paid $1,000 for that bond, you would receive $100. That's usually, by the way, annual, although it's often paid monthly. But in any event, if it's a 10% annual interest rate, and you have a $1,000 bond, you'd get $100 a year. And usually you do that monthly or sometimes annually. And at the end, you send it in and get your coupon back. So you never earn more than a certain amount. So in the example I gave, there's also a term of the bond. Let's say that was a 10-year bond. So that means that you would earn $100 over the course of 10 years, which is $1,000, meaning you would pay $1,000 and end up with $2,000 at the end of 10 years. Is that a good investment? Is that a bad investment? Depends what your alternatives are. But it's a fixed investment. You always get the same amount unless the company goes bankrupt in the meantime. So that's the risk you take. The company might not exist. These are corporate bonds. There are also treasury bonds, and we hope that the U.S. government doesn't go bankrupt. But you're going to get paid a very fixed amount, a specified fixed amount every month, unless and until the corporation goes bankrupt. So the safety of the bond depends on the nature of the corporation. Large corporations that have a long history of being solvent, like General Electric, are safer investments than issuances by smaller companies. And so that's the risk inherent there. The other feature about bonds is that even in the event of a bankruptcy, they are paid back first. They get priority in their payment. So that's one type of security. Now on the other side of the spectrum is common stock. And common stock, you don't get any payments unless the company decides to issue a dividend, which they don't have to do. So you have no guarantee of receiving any cash while you hold that stock. What you hope to do in most cases is resell that stock to somebody else for more money later. And so that's more like, you can think of like owning a house. The idea that the house is not going to give you a stream of payments, but hopefully when you sell the house in the future, it's worth more than what you paid for it, and you earn that difference. As opposed to if you owned a rental property and you kept it and you got a stream of payments from renters. So in the case of a common stock, all you get is the difference in value between what you bought it for and what you sold it for. And that value is usually dictated by the stock market. And by the way, we'll come to this when we talk about private markets. There is a third instrument which sits in between the two called preferred stock. And it has features of stock and features of bonds. It functions like stock in that you don't have a right to a certain amount of payment. If a bond is not paid, the bondholders can actually bring that corporation into bankruptcy court. So there's a heavy penalty for failing to pay out on a bond. Preferred stock will often have a dividend attached to it, a percentage each year that is to be paid, but if a preferred stock dividend is not paid, well, nothing happens. It might accumulate over time, or if it's not issued, it might simply disappear. So this gives it a bond-like feature of the stream of payments over time, but like common stock, no right to bring a company to bankruptcy court. So those are our two major corporate securities, stocks and bonds, and of course, preferred stock sitting in the middle. And in addition, there are investment contracts under the Howey test, which we won't get into too much. So if you want to sell these stocks and bonds to everybody, you want to sell them on the New York Stock Exchange, you have to register with the Securities and Exchange Commission. And you register, the requirement for registration is found in Section 5 of the Securities Act, which says, unless a registration statement is in effect as to a security, it shall be unlawful for a person to sell such security. In other words, all securities have to be registered before they're sold. And as we'll get to in a minute, there is a caveat. The caveat is unless they are exempt from registration. So in Section 5, we have the requirement for registration, and you can either register or find an exemption. And when we talk about staying private, that's about finding that exemption to the securities laws. And by the way, this is the registration statement, Form S1 from Facebook. It contains a lot of information. And in order to put one of these together, you go through a fairly lengthy and expensive process, working with the SEC, who will make various comments on your draft materials. It contains, for example, a business summary, which is going to have a description of the company, its products, its services, its technology. It will also have financial statements. So one of the consequences of going public is you now tell the world how much you're worth, what you're earning, what those lines of business are. And your competitors can use that information, right? They are now aware that Apple is earning X dollars per quarter or has certain costs. Now, not everything is going to have to be revealed publicly, but there's quite a lot of information, and that information has to be certified by an accountant, which is expensive. So that's a nice boondoggle for the accountants. The other thing that they contain is something called risk factors. And this is usually a set of very scary statements that basically no person in their right mind should buy this stock. The idea with risk factors is to basically come up with everything that could possibly go wrong, because the securities laws are built on a theory of disclosure, and you can be liable for a material failure to disclose. So the tendency is to put the kitchen sink into the risk factors, and you discuss every risk, every insecurity, every uncertainty about the company. You'll also include information about this issuance. We talked before, we talked about stock, that it's just a percentage of a company. So one thing you're going to care about is how many of these shares will be sold. If they're going to sell 1,000 shares, they usually sell much more than that, then they would have a certain value. If they can sell 1,000,000 shares, they would have a different value. So the offering size and the plan of distribution will be included. The company is also required to say how it will use the money it will earn by selling this stock. So there's a concept called use of proceeds, but just like when we saw the certificate of incorporation, remember, what did the company put for its business purpose in the certificate of incorporation? Yeah.
Any lawful purpose.
Any lawful purpose. Likewise, here, use of proceeds usually will say general corporate purposes. General corporate purposes. They want to make that as broad as possible so that there's no liability for using it for a non-specified use of proceeds. You also need to identify the management. Usually it gives some of their background, their age, their educational background. And the management will provide a discussion. They will have a discussion and analysis. And in addition, a recent addition to this is a disclosure of executive compensation. So the last major element on the S1, which is new, is the salary, both in terms of how much stock and how much cash and other bonuses these key executives earn. This is a recent addition, as there have been concerns about executive compensation, how much executives make. And you can find this form on the website, and while it may look simple to fill out, as you can imagine, deciding, for example, what risk factors to specify can be extremely complex, trying to think of everything. The way that it works in practice is that the firms that are drafting these will have done many, many before and have sort of a laundry list of risk factors that they'll tend to pick and choose from, as opposed to writing everything whole cloth. Sometimes it's easier when you see a list to sort of pick from it, as opposed to kind of coming up with everything each time. So how does the process work? Well, we have a new character in our picture, which are underwriters. And we talked last week about underwriters in life insurance contracts as well. And this is an agent that's going to essentially buy and then resell the stock. You may remember the analogy I made to Walmart versus Amazon. In the case of Walmart, Walmart actually buys all those pop rings, is that what they were called? The phone things? What are the
Pop sockets.
pop sockets, right? Walmart's going to actually buy and take title to those pop sockets and then put them in a bowl at the checkout counter and sell them to you. Whereas Amazon never takes title to those products. So Walmart is, in a way, acting kind of like an underwriter for pop sockets. It's taking the risk that those don't sell. It does have, of course, whatever, it's not a perfect analogy, but effectively the underwriter is going to buy the stock from the company, and then the underwriter is the one who resells it to the process. So a company seeking to sell shares to the public will work with the investment bank for months to get the IPO ready. And the investment bank will decide what price the stock should be sold at. They'll produce audited financials. As I mentioned, those are required. They may go through, one thing that's often very common is a company, especially now with tech companies that sort of do like just one thing, they may go on an acquisition spree and buy a number of companies, so they have like a more well-rounded business, and the investment banker may require them to do that. They may buy back some of those bonds, retire some of their debt in order to change their balance sheet, making them more attractive to investors, and of course draft the registration statement. So once the draft registration statement is filed with the SEC, the underwriters then go on what's called a roadshow. And they will actually fly around the country and talk to potential investors, because while you might think the public markets are people like you, really what they want is huge investment funds to buy massive blocks of stock right away. And they want to kind of prime the market and get these big buyers prepared to make these huge investments in the securities. And they put together, they call it a book of buyers. Now, notably, during this process, they are not allowed to actually sell anything because the stock is not yet registered yet. There's a lot of timing to work out. So there is a draft, they have to have a draft filing with the SEC in order to solicit, and then they go around soliciting and getting all this attention, and there's this really kind of crazy timing issue where you have to have the stock registered where everyone is super excited and ready to buy. And so there's a lot of last-minute stress about timing the market and getting it just right, and getting the SEC to sign off and be prepared to do that. When the SEC then signs off on our S1 statement, the issuer files a final amendment. What do you think is the last thing that changes before the stock goes public? Any ideas? Yeah. The date. Oh, on the form. Yes. That's not a substantive change. But there is a really fundamental substantive change. John? The price. The price is the last thing to change. They do not set the price until the last moment. The final amendment sets the price, fixes the date of the offering, but most fundamentally sets that final price and at which the stock will be sold. The underwriter then will buy the shares, typically at a huge discount, somewhere between 7 and 10% below that price. So remember, the underwriter is the one that's actually selling to the public. They will sell at the IPO price. But in order to compensate them, and they're very well compensated in many people's opinion, for taking this risk, they get a discount, and they're hoping to immediately liquidate that and make 7% immediately. In addition, there's a feature called a green shoe, which means that the underwriter, at their option, can purchase more stock from the company. So if it's really hot and the company is doing really well, the stock price is going bananas, the underwriter can then exercise its green shoe option. And by the way, I have no idea why it's called that, but it is called a green shoe option, and can purchase additional shares and resell those additional shares. And on that day of that IPO, what everyone is hoping for is the stock has a pop, that the stock value goes dramatically higher than that initial price really rapidly. And that used to happen all the time, and you could almost never lose by buying at the IPO until you could. And Facebook, going back to our Facebook registration statement, just for the visual here, Facebook was that story, where the stock price of Facebook actually tanked on the day of its IPO. It took a long time to recover back to the IPO price. Interesting stuff about why Facebook went public when it did. I'll come back to that, or maybe you can remind me to come back to that if you're interested. And I worked for the law firm that did the Facebook IPO. I didn't work on it personally, but I had colleagues that did, and so I have a little bit of inside baseball on that. Nothing confidential. So now that the company has gone through this process, they are now public, they are now listed, and the key thing to remember is that once that stock is sold, the price varies, but the company doesn't get more money because the stock price goes up. The company raises money by selling to the underwriters. The underwriters make money by selling to the public, but then it's the public selling to each other. It's the public selling to each other. So why does a company care if its stock price goes up or down after its IPO? Sure.
They usually own a lot of stock.
They may own a lot more stock, right? Some of the stock may be held as treasury shares, which they can resell, right? They can essentially buy the shares, hold them in the treasury. A corporation may own a lot of its own stock. That's one reason. And the second reason, they may sell more stock in the future. And if they sold their first issuance of stock for $40 a share, and that stock popped to 60 and stayed there, they could sell their next set of stock for $60 a share, or maybe more. And by the way, not super important to get all the forms right, but once a company is registered, they would file a different set of forms to register additional securities. And there's all kinds of other concepts called a shelf offering, et cetera. So it gets a lot more complicated than this, but that is effectively the IPO process. Before I move on to the responsibilities of a public company, are there any kind of questions about that basic process? The key thing to remember is that the company makes money by selling to the underwriters. So their key negotiation is getting the underwriters to pay as much as possible. The underwriters are the ones that sell to the public. And of course, the underwriters will pay what they need to pay. They will base their price off how much they think they can sell to the public, so it's not irrelevant to the company. But it's really that relationship with the underwriter that's where the company sees its value. So once the company is public, yeah, Tyler.
I just have a question. So, like, theoretically, like, making it easy numbers, if they have 20 shares that they can issue, they issue 10, they sell it to the underwriter, and then there's a big pop, and they're like, all right, let's sell these 5 others. Do they go direct, or do they use the underwriter again? Like, do they always go through the underwriter, or do they start?
They would go, there are some exceptions to going through underwriters. And Google is one example where they did not use an underwriter, but usually what would happen is the company will, at the IPO, you mean at the IPO or you mean some point in the future?
Like the IPO, the stock price shoots up, and like a
That
couple
day.
days later, they're like, hey, let's sell these 5 others.
So usually they won't register more than they intend to sell at the IPO. So there won't be more to sell without an additional registration process, and that will invoke a new negotiation with the underwriter, and it will go through the underwriter. Or there might be this green shoe option where the underwriter has the option to sell more of those shares or not, and there could be some shares that were registered and not sold, but usually the underwriter reserves the right to sell those as well. So in almost all cases, the only difference would be if the company purchases them back from the market and holds them as treasury shares. So now the company is floating around, publicly traded, and sorry, I had thought I had muted this, but I'm going to go ahead and do that. Once the company is publicly traded and its stock price is floating around, it has greatly heightened responsibilities to society. And this is once it's listed. And so here I have a Form 10K from a company you probably have heard of, Coca-Cola. Coca-Cola is a publicly traded company, and that means they have to make annual, quarterly, and special filings. Annual, quarterly, and special filings. Annual filings are 10Ks. That's the big one. That's going to contain all the bells and whistles. And the 10K is filed, it's not necessarily, by the way, filed in December. Publicly traded companies usually have like an IPO season and have an annual, they can choose what their year-end date is. So the corporate year-end date is not necessarily the calendar year-end date. In this case, we can see it says for fiscal year ended December 31st, 2008, but the fiscal year does not always end with the calendar year. Anyone have an idea why a company might choose a different time to end their calendar year? Well, I'll ask that. Let me give you a little more information. I'll ask the question again. What's contained in this is going to be things like, just like we had in the original statement, it's going to have information about management, it's going to have the balance sheet, cash flows, new products, risk factors, things like that. So, knowing that it contains all of that financial information, why might a company choose a different year-end date? Yeah.
What if it's like a company that has some sort of seasonal aspect?
A seasonal company. So, for example, retail, right? Retail usually does its best sales between Black Friday and Christmas. Now, it's changed with Cyber Monday, but Macy's, I'd have to look it up. I imagine, I would bet, no, I shouldn't say bet because it's a very precise date, but I would guess that Macy's has a fiscal year-end date of March 31st. Because that gives Macy's 90 days to prepare their accounting statements, including all of their Christmas sales. And that's going to reflect them at their best. On December 31st, Macy's, and this is looking back 90 days, right? Because it takes time to prepare these financials. They're not like up to the very last minute that they're filed. I mean, what are Macy's sales like in October? Well, probably not as good as November and December. So one reason to change that date is really for marketing purposes. I mean, this is kind of a marketing document. It has a sales pitchy kind of feel to it. And oftentimes they're, published with cool pictures and whiz-bang graphics, and nowadays they include a lot of like investor-friendly kind of features that showcase the company and make it look good. And then they have in 10-point font, 27 pages of risk factors that tell you why you should definitely not buy this company that just got advertised. Do you guys actually want to see kind of what that looks like? The actual investor packet is, so the way to find this, so we'll do Coca-Cola, investor relations, and almost every public company is going to have, there you go, an investor relations page. Now, as I mentioned, there are quarterly and annual filings. So you see here, and this is the abbreviation Q4, Q3. These are quarters, third quarter, fourth quarter. Then they're going to have their annual filings. Let's take a look at their look back report. The results are strong. In fact, I didn't even know they're doing this now. They're doing a video. It's only a minute, so you can take a look. Like I said, marketing materials. And really, I mean, that looked like a super commercial, except with various financial information. Now, the earnings themselves are, I guess they're doing this. This is actually new to me. I didn't plan this. I just I did not realize they had moved to this. Well, it's much more like interactive, video type of model that probably appeals to a different generation of investors. And so they're going to have these various news releases, and they're also going to have a bunch of boring financial stuff, which, interestingly, as I'm looking, usually I was expecting just links to the boring financials with a couple pretty pictures. The boring stuff has really been buried in this website, really showcasing, even more than I expected, the financial stuff. Here's their actual 10K, though. 3 clicks to get there. 3 clicks to get there, 1 click to get the promo ad. So let's make this a bit bigger. All right, risk factors. This is the less fun news. Oh, wow. All right, let's get off to a good start. Obesity and health concerns may reduce demand for our products. Water scarcity and poor quality could negatively impact our system costs. If we do not address consumer preferences, our business could suffer. Increased competition could hurt our business. Product safety and quality concerns negatively affect our business. Public debate and concern about perceived negative health consequences of certain ingredients may reduce demand for our beverage products. If we are not successful in our innovation activities, our financial results may be negatively affected. Blah, 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 blah. It goes, I wasn't kidding about going on for 20 pages, right? It was page 10 that it started. Okay, so I was exaggerating a little bit. That was 10 and a half pages of risk factors. And compare that to the excitement and the showcase of the marketing style video that we just saw, which included none of this information. Interesting, right? Yeah.
Who comes up with these risks? Like, whose job is that?
Securities lawyers. There will be at a company this big, there will be an in-house lawyer who is going to be working with an outside law firm, and they will spend approximately, a company this size will probably spend $3 to $4 million per year drafting these documents and dealing with the audited financials. So a combination of legal and accounting spend to draft these. We're talking millions of dollars a year. And so there will be usually, an outside law firm with a partner, an associate, junior associate, a paralegal, and at least a general counsel, and a company like this might have even an in-house person dedicated full-time at $180,000 a year salary drafting the stuff. A lot of lawyers. And they will work with management. So the lawyers then have to, and the reason that you need someone on the in-house side is because they have to have those relationships with management to ask these questions. And management is always saying, we don't really need to say that, do we? I mean, come on, this thing about obesity and sugar, that's not really and the lawyer's like, yes, we do. We're putting it in there. And I guess somebody convinced them to put it in there and then make a snazzy video that they didn't, which didn't even, I don't know if you saw, there's a little asterisk on the video that even said that the numbers are not according to GAAP, meaning they're not audited and they're not subject to financial standards. So anyway, like I said, that actually was new to me, and I think that was cool to share that with you. But you could really see the marketing aspect of it, and then compare that. And what are, I don't know, you tell me, what are investors going to spend their time looking at? What was more amusing for you? And if you felt that video was informative, would you necessarily start digging through all of this stuff? So other things, by the way, that we have in here, legal proceedings. Apparently they're being sued by a number of places. Mine safety disclosures, so various environmental disclosures. I suppose they don't own any mines, but apparently there's some statute out there that says a publicly traded company has to make a disclosure about its mines. Yes?
I was going to say, if I'm a hedge fund or somebody like that, it would be
The hedge funds were going to read this. Yeah, I mean, the major investors read this, or at least read analyst reports. So, in addition, who definitely reads these are analysts, and of a company of this size, there will be multiple analysts that are going to read those, and they will issue a recommendation called an analyst recommendation. And they in here are going to recommend, based on the current value, market trends, what's in the disclosure, either buy, hold, or sell. And we can actually see here that it's actually counting the number, basically it's counting the number of reports. So apparently, at least, and this is a NASDAQ traded company, it looks like there are 13 analyst reports on Coca-Cola. So we know at least 13 people read this. The hedge funds probably do too. But a lot of people would just, if you didn't read the report, you might just read the analyst reports. And if you don't read the analyst reports, you might just look at the numbers. And if you don't just look at the numbers, you might just look at the price. And if you don't just look at the price, you'll probably still watch the snazzy video. So there are different levels of investor commitment. But it is a useful thing to do if you're thinking about buying a stock, and you're like, oh, I really think Macy's is going to do well because they finally got rid of coupons. If you've ever shopped at Macy's, then you do know about coupons because they're like the coupon king, So they actually tried, by the way. It was a whole failure because apparently Macy's customers really like coupons. So like this, lowest everyday price that Macy's and Walmart attracted different people or they had different mentalities. Anyway, point being that you might have this idea Macy's going to get rid of coupons, the stock's going to go through the roof. Before you pick stocks based on something like that, I would recommend you at least take a look at what the analysts are saying, and you can get that aggregate picture here. And here are some of those firms. You will probably recognize their names. Bank of America, these are the analysts. Deutsche Bank, Jefferies, that's an underwriter, an investment bank. SunTrust Robins, it's another bank. Co-Forecast, I guess that's just an analyst firm. Edward Jones, J.P. Morgan, Wells Fargo, Cohen & Co., Gabelli & Company, and Morgan Stanley. So those are the companies that have written analyst reports on Coca-Cola. By the way, anyone here want to pick another stock just while we're out here throwing things at the dartboard? Anyone have a stock that they think is going to, I guess, yeah?
Think is what?
Going up, yeah, that you would buy.
I was just curious. I was going to say Tesla.
Tesla's an interesting one. I'm sure there's a lot of analyst activity around that. Wow, this is interesting. You don't see this too often. Tesla is all over the map. Usually there's going to be more consolidation around buy or hold. Really weird. Interesting you brought that up for a company to have several strong buy recommendations and several strong sell recommendations. That's not common. That's unusual. So people have really different views on Tesla. 8 strong buy, 4 strong sell, 7 hold. Yeah, that's interesting. And we have a couple of those names coming up again. Oppenheimer is new. And so, apparently the overall picture for Tesla is buy, but hey, maybe read these reports. Now, why is this information valid? Well, again, going back to the sticks that we wield against our public companies and the investment advisors, as you will learn, I've learned, thankfully, you will learn from Professor Echeverry, fraud liability. So material information or misrepresentation of material information leads to serious fraud penalties for this. So in addition to the responsibility, there's also that sort of stick involved there. And then again, just as a reminder, after the stock is registered and has all those requirements, it will then also have to go through the additional hurdle of listing. And not every company can get listed on the New York Stock Exchange or the NASDAQ. That's sort of a premier or prestige thing, and they have a number of requirements, and we could look into those as well, but certain amount of capital, certain number of committees, certain independent committees that provide oversight. It's a lot about governance, a lot about various corporate governance obligations above and beyond what you need to be registered. And so why be on a premier exchange? Well, prestige is a big reason, access to markets, there are companies that are listed on the Philadelphia Stock Exchange, but there are probably no analysts reporting on them. So you want to be listed on the biggest exchange that you can, basically. And the NASDAQ has that additional kind of techie feel where people go when they're expecting to invest in tech companies. All right, so just to recap and ask a couple questions. So what is the purpose of this registration? All right, what does a registration do? It produces information, public information. The goal, the reason for requiring registration is these statements contain a significant amount of information that has now been released to the public, which theoretically can help people make investment decisions. Does it work? Well, it's kind of debated. it's unclear exactly who's protected. I mean, individuals, maybe some of you will read those financial statements, but okay, so what? So you read a financial statement that says that because of concerns about obesity, Coca-Cola is concerned about its financial future. And you watched a video that said, with cool, funky music, yay, Coca-Cola, 2% something I didn't understand, 11% something else, yay, chart going like that. And then you saw an analyst report, or a combination of analyst reports. You couldn't actually get the report, but so what do? Was that information helpful to you? Maybe. Maybe not. I mean, in order to make sense of that, you would also need to look at Pepsi and other beverage companies and Costco and other investments in other markets and make a number of predictions. So it's not clear that people read or understand these things or how much value they get out of them. Sophisticated investors may read them, but sophisticated investors could potentially bargain for that information anyway. So it's not entirely clear how effective these are. They're extremely expensive. That much is clear. And as a result, companies will try to avoid this when they can. So then we define a security, and a security includes stocks, includes bonds, includes investment contracts, as the Howey test will indicate. And all securities, before they are sold to the public, need to be registered unless they're exempt. When they register, they begin with an initial public offering, which requires registering on a Form S-1 and listing, and then these companies trade publicly, and large companies have a lot of information about them that you can use to make your investment decisions. Any questions about public markets?